What's up, everyone? Welcome back. Patrick here. Moving on to the next topic in financial accounting. We're now going to talk about unearned revenue in this video. And I'm going to go through unearned revenue in a very similar way that I went through prepaid expenses. So if you remember with prepaid expenses, we first started off showing how expenses can be incurred generally. We had a bunch of different cases, and then what happened was we went through each of the cases specifically. We had specific examples, and so I'm going to go through the same process when describing unearned revenue. And to start it off, I'm going to start with the question, when will revenue be earned? So let's pretend we're the company that's actually going to be earning the revenue. Now, when you're earning revenue, you may see different definitions in textbooks come up. The way I like to think about it, it's either you provide a service or you deliver a good. And when I say deliver a good, I don't mean like you're the delivery company giving a good. I mean you provide that good. You produce the good, or you have the good and you provide it to a customer. So I could have even wrote provide service and good, but I'll just leave it at deliver good. So either one of those means that you earned revenue when those actions take place. So revenue can be earned either now, so we could earn it now. And if you remember, now means this period, whatever period you're looking at. Or you can earn it in the future, in a future period. Now, if you earn revenue now, meaning that you provide the service during this period or you deliver a good during this period, one of two things are going to happen, or a mixture of both even. Either you're going to be paid now in this period for that service or good, or you're going to be paid in a future period. And then if you earn revenue in a future period, which hopefully you will if you're a going concern company, you can actually be paid ahead of time. So you could be paid now for revenue that you're going to earn in a future period. So you could be paid now for a service that you're going to provide in a future period, or maybe a good you're going to provide in a future period. And then the other possibility is you could be paid in the future. And that obviously makes sense, right? If you're going to earn revenue in a future period, you're going to be paid in a future period, then it would become this case once that period comes about. So first thing I want to mention is notice how earn and paid are two different things, right? So you can earn revenue but not be paid in the same period. You could be paid in the future. Or you can earn revenue in the future and be paid now. So both of these are different things. And paid, whenever you're paid, usually that's with cash. It could be with any asset, but we're going to focus specifically on cash mostly in this video. And specifically unearned revenue, out of these four cases, where it comes about is in this case over here. So this is where you have unearned revenue. So it's revenue that you haven't earned yet because you're going to earn it in the future. You're going to provide that service or deliver that good in the future, but you've been paid for it now in this period. Now, revenue in general, for it to be classified as revenue, for a transaction to be classified as revenue and then go on the income statement, it actually has to be earned in the period. So it's only in these cases here that we can classify a transaction as revenue. It can only be classified as revenue if you provide the service or deliver the good in this period. So if we're providing a service or delivering a good in a future period, or we're earning revenue in a future period, it can't be classified as revenue yet. Over here, so either of these cases. But then you might ask yourself, well, it says unearned revenue. So isn't that a type of revenue? And it's actually not. It's a little confusing, but whenever you see unearned revenue, this is actually a liability on the balance sheet. So revenue here goes on the income statement, but unearned revenue, it's not a type of revenue. You got to remember that. I know it's a little confusing. It's actually a liability. So it's very similar to a prepaid expense, right? A prepaid expense is not a type of expense. It's actually an asset, right? So expenses, if you remember, they go on the income statement, and then a prepaid expense is an asset. Same thing with revenue. Revenue goes on the income statement, but unearned revenue, it's not a type of revenue. It's actually a liability, and that goes on the balance sheet. And so these are the 4 cases. And we're going to go through specific examples for these cases, except for the 4th one, because this one here, when, again, as I mentioned, you earn revenue in the future, you're going to be paid in the future, that's just going to become this case over here once you get to that period. There's no transaction that's happening in this period. So with cases 1, 2, and 3, there's going to be transactions that have to be accounted for in this period, versus 4, all the transactions are going to be in the future. Now, before we get into the specific examples, what I want to do is actually just in general, I did this with the prepaid expenses as well. I want to show what the effects are on the equation for each of these cases, just in general, with just plus and minus signs. So you can always refer to it, and then we'll go into specific examples. So this first case here, if you earn revenue now, so you provide a service or deliver a good in the period you're in, let's say it's a month, and you get paid that month as well. Well, if you get paid for it, what's going to happen is your assets are going to go up, usually cash. And then also you earn that revenue that month, so your revenue is going to go up as well. Right? So notice that, and this is going to be different types of revenue. So if you're providing a service, it'll be service revenue, or if you're delivering a good or providing a good, it'll usually be sales revenue. So there's different kinds of revenue that you can have here. But this, just generally, is what's going to happen in this case, in scenario 1. Now, in scenario 2, actually, you know what? I'll just erase this. So that's scenario 1. In scenario 2, what's going to happen is you're going to earn the revenue now, you're going to provide the service or deliver the good now in this period, but you're going to be paid in the future. So what would happen in this case is you earn the revenue in this period, but then you also get an asset, but it's not going to be cash, it's going to be accounts receivable. Right? So that is the amount that you're owed in the future from your customer that you provided that service or delivered that good for. Right? So that's going to be the first transaction. That's going to happen now in this period. And then in the future period, when you actually get paid, what's going to happen is you're going to receive the cash from the customer, and then that accounts receivable is going to go down respectively. So it starts off with this now in this period. You earn the revenue, but you're going to be paid for it in the future. And then in the future period, once you're paid for it, you get the cash, and then that accounts receivable goes down. So these two transactions are what happens in this case when you earn revenue now in this period, but you're going to be paid for it in the future. Now the third case, the one that basically this video is on, you earn the revenue in the future, but you get paid for it now. So let's pretend that you have maybe a lawn care company. And then what happens is, let's say you're in the month of October, and let's say there's November. Well, let's say that a customer pays you in October for you to provide the service on their lawn in November. So that's when you're going to provide the service. So even though you got paid, you haven't provided the service yet. Right? It's only when you provide the service that you're going to recognize that revenue, that you're going to earn that revenue. But you've been paid for it in October. So with accrual accounting, again, you can get paid and earn revenue in different periods. So what would happen here is you got paid now, so your cash goes up, but you haven't earned the revenue yet. You haven't provided the service or delivered the goods, so it's not going to be revenue. And as I mentioned, it's going to be a liability. So this here is going to go up. This is going to be unearned revenue. So liabilities doesn't necessarily have to be money that you owe to others, like accounts payable or certain loans. It could also be services that you owe to others in future periods, or goods that you're going to deliver. So for example, if this happened here, if someone paid you for a service you have to provide in a future period, like that example we just did, and then let's say that right after this transaction you sell the company. Well, when you sell the company, the buyer of the company is going to receive this cash, but they have to know that they got to provide that service in the future as well. And so that's why that liability account has to be there. And if you notice with this here, notice that the left side and then the right side are actually balancing out. So it's kind of like, notice how revenue is a plus here. It's almost like we just took this and then shifted it here. So mathematically it makes sense as well. We have a plus here on the left side and then a plus on the right side. And then notice when we earned the revenue in the same period and got paid for it now, it was plus and plus. So it's just like we're taking this plus and putting it here, right? So it's still balancing out. So it mathematically makes sense as well. So this is what happens now when you get paid for it now. You still have to account for that transaction, but you don't recognize that revenue yet. It's unearned revenue, which is a liability. And then once you provide that service in the future period, what would happen is that unearned revenue goes down, and then you recognize that revenue, whatever it is, whether it's a service revenue or a sale revenue, right? So this is what would happen in the future period. So notice that in this case, there's like this preliminary step there. Instead of having cash and then revenue like we had in case one, because when you got paid and when you earned it is in different periods, there's got to be this preliminary step here, this preliminary account, you could think about it, or a temporary account, where you got this unearned revenue, it's a liability, and then once you actually provide that service or deliver that good in the future period, that unearned revenue goes away, minus, and then you recognize that revenue. And notice this balances out as well, because you got minus and then plus all on the right side. So those would net out to 0 on the right side. Right? And then you can have, let's say someone paid for your service for multiple periods, for multiple months. You can have this transaction repeat multiple times. That's going to happen a lot as well. So this here would be case 3. And then as I mentioned, case 4, there's no transaction that would happen now in this period. Basically, case 4 would become either case 1 or case 2 once that period comes about.